Welcome to Building Solid Foundations. I'm your host, Steve Matley, president of Coast to Coast Equities. Last week, we were talking about real estate investments, creative real estate investing secrets of the pros. And we went through typical real estate investments that most people understand and some advanced real estate investments. And we had just got into talking about some expert investments, which is leading us to where we really want to be. And where that is answering the question that I've been asked, which is explain those type of projects you allude to and refer to when you're talking to your guest on other episodes. So this is part of helping you build your solid foundation of your own personal financial wealth. And it's something that is actually accessible to people that they don't know is accessible to them. A lot of people go through and they see other people investing in things and making money, and they wonder, how can they do that? If you are in a position where you have no money to invest whatsoever, I encourage you to go back and watch our episode we did about a month or so ago on personal financial literacy to learn about kind of getting out of debt and getting to a point where you get some money aside that you can work with. And once you have some money to work with, or you have, say, a self-directed retirement account, we have an episode a couple months back we did on that too. Look that one up as well. We talk about self-directed HSAs and IRAs and how to use 1031 exchanges for some of these things. Refresh yourself on some of those techniques, and you'll kind of see that maybe you have ability to do this even if you think you didn't. So let's get into reviewing a little what we talked about last week. Last week we talked first about typical real estate investments. And there's a list up on your screen you can see. And the typical real estate investments are what most people understand and know. Buy and hold and then sell your residence as the market appreciates. Buy, hold, and do the same thing, sell a rental property, one you don't live in. Buy, fix, and then sell your residence. This is one where you buy a residence that is in disrepair, you fix it, and you're getting the upside from both the repair and the market. Or do the same with a rental. Buy it, fix it, rent it out, and then sell it. Or do the fix and flip, which we see commonly on TV shows, where we buy a piece of property that's in major disrepair, we fix it up, we flip it over as soon as we're done. So those are the typical real estate investments. And we went through some of the pros and cons of those last week. The more advanced real estate investments we talked about, moving up a level, was there's another list coming up on your screen. And that is buy and then live in or rent out and hold a multifamily unit. These would be probably 2 to 4 units. They can be up to a dozen or so. Do the same thing, but buy one that's in disrepair and fix it, and then hold on to it as it appreciates and then sell it. We can buy, lease, and then hold on to and manage or sell commercial property, light commercial property. We could do the same thing by just buying and leasing and then selling. We buy empty commercial property, we put a tenant in there, lease it up, and then sell it over. And we can do the home side, the residential side, where we buy a piece of land, we design a home, we build the home, and we sell the home to a homeowner at the end of it. So those were some more advanced real estate investment projects, and we talked about the upside of those and the downside of those last time as well. I encourage you, if you didn't see last week's episode, go back, catch up on that, and then you'll kind of get up to speed on where we are today. So today what we want to get into is pick up where we left off last time, which is that expert real estate investments. So let's talk about some of those expert real estate investments. There's another list coming up on your screen right now, and that is going to show you different types of expert real estate investments. We can buy and then do a tenant improvement or a build-to-suit for a commercial property and then lease it or manage it. Tenant improvement means the building is there, but we fix the inside of it to fit a particular type of tenant. And a build-to-suit means we take the empty piece of land and build a building to suit the leaseholder that we're going to be leasing to. We can buy and then lease or manage and then sell a large multifamily property. This is going to be a larger apartment complex. Could be a high-rise, could be a complex of mid-rise apartments. It could be 100 doors, it could be 50 doors. So it's going to be a larger, something bigger than 2 to 10 type unit. We can do this build, instead of buying one, we can build and then lease or manage and then sell a multifamily or mixed-use facility or a commercial facility. We can buy, entitle, and sell raw land, and we're going to get deeper into that in this episode because that's the kind of projects that my company specializes in. We can buy and then entitle and develop and then sell the land. So when we buy the land and then we entitle it, that gives us a legal right to change the zoning on it, to build on it. And then we can sell that land, or we can build on the land, or we can sell it to someone who will build on the land, or we can build it out ourselves. We can do commercial. We can build out commercial and lease it out and then sell it. Or we can hold on to it and manage it. We can manage these type of properties. So that's expert real estate investments. And we kind of laid those out last time, and I want to talk a little about the ups and downs of the expert real estate investments. So the upside of the expert real estate investments is, honestly, this is where the real money's made. This is where people make money in real estate. The moguls, the people that really became wealthy in real estate, didn't do this by buying a house here and a house there and getting 6%, 8%, maybe 10% back on it. No, they were making large sums of money by doing much larger projects, with higher risk, I might add. You can build a sustainable portfolio doing this, where you have an ongoing portfolio of income-producing properties and appreciating properties that will sustain you, and this becomes, honestly, this can be much larger than what you can earn off of a standard career type income. And this is real property that you can hold in a business enterprise that easily passes to your legacy. You don't need to worry about going to probate or any of those kind of things. You hold it in a business entity, and the business entity outlives you. If this is in a corporation, it moves on to the other shareholders, which could be your children, it could be your spouse, could be other relatives. So this is something that really can create a lot of wealth that can be passed down. Now, here's the downside of it. There are some serious barriers to entry on this, obviously, because everybody would be doing it if they thought it was easy. It requires significant capital. When I mean significant capital, I mean you're talking millions, hundreds of millions of dollars on these things. Most of us don't have that laying around in our bank accounts. Very high equity to loan ratios on these, which means where you buy a house initially, let's say with an FHA loan, you can buy it for 3% down, and then 97% of that gets financed. These, you're going to need at least 50% of equity in this, money up front, your own money to come in, or money with investors, in order to get the loan for the other half of that. You may have to require personal guarantees to do the building on these things. Construction loans require personal guarantees, and what that means is, even if you're in a corporate structure where you've got the liability protection, you sign an agreement with the lender that says they have the right to pierce that and come after all your personal assets if you default on that loan. That means you have put your kid's college fund and your retirement fund and grandma's china and your house and your car and everything up on a roulette wheel and spun it. You need a lot of expertise to manage very complex projects. People that manage these things have been around the block, and they've been doing these for many decades. Many have specialized education and training. There is a potential liability if you're building. You are liable for defective construction if it's a problem, either with building damage or loss of life or safety issues. So it's much higher risk, very high risk and high capital required. And I don't want you discouraged on that. We're going to have to take a break, but I want to leave you on a note that there are ways to overcome these obstacles so that these barriers to entry may not be barriers for you. I'm Steve Matley. This is Building Solid Foundations. We're talking about creative real estate investing secrets of the pros, and we'll be right back after this.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
And welcome back to Building Solid Foundations. I'm your host, Steve Matley, and today we're doing part 2 of a 2-part series on creative real estate investing secrets of the pros. And we have been going through different types of real estate investments, and right now we're in the midst of talking about expert level real estate investing. In the last segment, we laid out the different types of options there are in expert level real estate investing. It's by no means an exhaustive list. There's a lot of other options out there. But we did go through some of the problems or barriers to entry, the downside of doing these. Just to recap, requires a lot of money up front, requires significant capital resources, millions, tens of millions, hundreds of millions sometimes. High equity to loan ratios means you have to have a high equity position in that to get any loans out of the deal. So if you're at a property and you need $50 million of equity to get a $50 million loan, that's tough. You may require personal guarantees, meaning that you're exposed, all your assets are exposed if you default on the loan. personal assets. Expertise is required to manage these projects. There's professionals that do this for a living that have degrees and many decades of experience that run these kind of projects. There is a high potential liability if you're doing construction and building because of defective construction and life safety issues that come with construction. And of course, there's a higher risk overall because you're at a much higher level of resources that are exposed. So there's a lot more to lose here. Now, I don't want to say that to discourage you because, again, our company specializes in a particular type of one of these projects, and we found ways to overcome a lot of these barriers. So let me go through some of those real quick with you. Here's some ways to overcome the barriers. First, the building side. Building comes with a lot of risk to it. There's loan risk, there's human life and safety risk for the workers and for people after the fact if there's anything goes wrong with the construction. There is building damage risk, all kinds of different issues that come with that. So how do you avoid that? Well, there's three strategies to risk. There's risk acceptance, meaning you just accept the risk and deal with it. And then there's risk transfer, meaning you give the risk to someone else. And then there's risk avoidance. Risk avoidance means don't do it. That's our solution to this. The way to get around building, and I'm a person that comes out of the building business. I've spent decades as a construction manager, general contractor. I know the building business. This is an area I know very well and can do competently, and my choice is to try and avoid a lot of that risk by just not building if I can avoid it. So there's no construction loans required, and there's no liability then. On the significant capital required, you can pool resources. It doesn't all have to come from you. And you don't need to have as much money as you think if you're doing certain elements of the project. You don't need to do the whole thing from buy the land to here's the keys. You can do a piece of that puzzle and turn it over to someone else to do the rest of it, which is what we like to do. So we can pool the resources. We share the capital with other people. It's known as syndicating. We put an entity together that people come in and they actually buy shares of that entity, that buys shares of the company that then owns the project. And that way, you can come in with much, much less capital because a lot of people coming in with a little capital equals a lot of capital. Expertise. Well, you don't have to go learn everything. You don't need to spend the next 25 years doing this to the point where you can do it competently without making a lot of mistakes. Invest in a project that's run by experts who already know how to do it. Find the people with the expertise that you trust and invest in their projects. Personal guarantees. We don't personally guarantee loans of any type, ever. We won't do those projects. Now, I will tell you, there's a lot of opportunity when you do those. There's a lot of upside and a lot of money to be made, and it can be tempting. We've had projects where builders have come to us and said, look, if you come in with the land instead of us buying it, you partner with us, and then you help us get those loans because they're looking at there's more assets to collateralize that loan. And we say, absolutely not. We'd rather leave that money on the table and not take that risk. The higher risk, how do you avoid the higher risk of all this? Simple. All the above we just said. Avoid the building, pool the capital, find the experts to run the project for you, avoid the personal guarantees. And a lot of these downsides will go away, and these barriers to entry that prevent most common people from getting into these really expert level projects that have high upside are now overcome, and you can get into it. So I'm going to talk to you about one option to do this. How do we have an option to do a project where we can mitigate these risk factors and barriers? Well, this is known as a land entitlement project, and there should be a graphic coming up on your screen now. These are known as land flips. You're familiar with a house flip. I'm going to compare the two at the end of this, but a land flip is like a house flip, only instead of physically fixing a house by construction, we fix the land legally. And what I mean by that is we purchase and then we entitle the land legally and then we sell the land. It doesn't work everywhere. Why does it not work everywhere? Well, because the person you're going to sell this land to is generally a developer or builder who is looking for land that's entitled. Now, in a lot of states across this country, and if you live in states like this, just be thankful that you live in those states. There's a lot of states where it's not as arduous and restrictive. There's not a lot of red tape. And frankly, most people, if they know a basic amount of what they're doing, in 90 to 120 days can do what seriously takes us a half a decade to a decade to do here in California. And that's no joke. You think I'm exaggerating, but it's the truth. Now, projects that my company works in, we specifically pick areas and cities that are very pro-growth, or at least pro-growth for California. And what that means is we can get our projects through in 18 to 30 months. Now, I know that sounds like a long time if you're living somewhere in a state that doesn't have these restrictions. Thinking, what are you, crazy? We could do a bunch of projects in that time. Here in California, that's lightning fast. in the coastal counties of California, it can take, for small projects, it can easily take 3 to 5 years to get your approvals. If you're on a large project requiring specific plans and environmental impact reports, it can take you over 10 years to get your approvals. And that's no joke. And so that creates a problem. So that's a problem for most people. For us, it creates a profit position. Why? Because builders will buy from us here if we have the entitled land. In other states, they just do it themselves. It's easy for them to do it themselves. Here in California, it reduces their risk. They're not sitting on land for 2 or 3 years while the market turns on them while they're trying to get approvals. They can buy from us, and all they have to do when they buy an approved tentative map from us with the property that attaches to it and all the supporting documents, all they need to do is do the final engineering, record a final map. They can do that in 90, 120 days and start moving dirt around on that project site. So let's talk about what a land flip is. The next graphic up, and you'll see that there's a picture of, it's the same property. The first picture shows it as a parcel map. It is 3 agricultural parcels. Each one of those parcels may be able to put 2 homes on it. The next one is what it looks like after a map has been drawn on it, meaning that we have broken it into 100 plus home sites. It's worth a lot more now because instead of 6 homes, you can put over 100 homes on these, 150, 200 homes, depending what your density is. We purchase raw or unused land. It's agriculture or rural residential zoned. We perform the entitlement process. We look at the city's general plan and we fix it so that it is what the city wants to see if it has more lots on it, so it's no longer agriculture, it's for homes. Once entitled, we sell it to the buyer, who is a builder or a developer. They will be the ones that do the infrastructure improvements and build the homes. We can do this individually or corporately, meaning we can have a single funding person come in with a lot of money to do this project, or we can syndicate it and have a lot of people with a smaller amount of money come in and pool their resources. And there's different structures that we can employ to make this happen. We tend to use syndication, and what that means is we form a separate entity, its own company, for each individual project. And for that project, we then have a pool of investors that can come in. We have a certain number of investors that we will allow to come in for a certain minimum amount of investment, and each share equals a certain percentage of the project. And essentially, we as the owners are selling off percentages of that company, which owns the land and the map and all the documents and everything associated with that project. When we're done and we have an approved map, we will then sell all of that to a builder, and then we will split the proceeds with all the investors. And that's how everybody makes money. So that is what a land flip is. And we're going to go a little deeper into some more of this. We're going to talk about, there are some risks. This is not risk-free. Don't think it is, but we've mitigated most of the risks. And there is a huge upside. So we're going to get into that after this break. Right now, I need to take another break. I'm Steve Matley. This is Building Solid Foundations, and we are talking today about creative real estate investing secrets of the pros. Specifically, we're getting into land flips. I got more to cover, and you're not going to want to miss it. Don't go anywhere. We'll be right back.
If you love them enough to relearn math so you can teach them math, then surely you'll check nhtsa.gov/the right seat to make sure they're correctly buckled in the back seat.
You made your house a reality. Homeschooling yourself on loans, color-coding listings, and flushing every toilet in a 20-mile radius. If you can ace house hunting, you can do it for retirement. Get on track with tips at aceyourretirement.org.
Welcome back to Building Solid Foundations. I'm your host, Steve Matley, president of Coast to Coast Equities, and we've been talking about creative real estate investing secrets of the pros for the last week and this week, and we're wrapping it up this week. We have been talking about typical real estate investing, advanced real estate investing, expert level real estate investing, and some of the upsides and downsides. And what we just went through was a particular type of expert level real estate investment known as the land flip or the land entitlement project. And we just explained what it was and how it works. Now, we're going to talk about what the downside to these are, because every kind of investment you're going to do has some kind of downside there somewhere. There's always a risk or there wouldn't be a reward. And on a side note, sometimes investors I'm talking to, potential investors, they'll ask me, they'll say, well, is there a guarantee on this project? I'll say, well, there's 2 guarantees I have. One is that there's no guarantees on anything in life, that there's a risk. The second is, I can tell you that while our project doesn't have a guarantee, I know a place you can go to get absolutely guaranteed investments. It's called your bank. You can get a CD or a T-bill. They're guaranteed by the federal government. The interest is lower than the inflation rate, so you're probably not going to make any money on it. But that's what guaranteed gets you, is no return. That's the nature of investing. So, having disclosed that, I'm going to talk about some of the risks of land entitlement projects. Here in California, it requires relatively long time periods, and I explained that a little bit in the last segment. It can take a long time, especially if you're towards the coastal counties or the more developed cities. If you're in the metro areas, these projects take years. They can take over a decade or more. There is a recent project done by one of the public builders in North San Diego County. It took about 12 years to get that approval through. That's a long time to wait. Most people don't have patience for that. So there can be long time periods for these things. There's no guarantee of obtaining your desired zoning. There's a risk. You could go through this and do everything you're told to do, exactly the way they told you to do it and what they said they wanted for the zoning. And when you get to the planning commission meeting, they decide against you. Why? Well, maybe 100 angry neighbors showed up and decided they didn't want what you had to offer, even though the city had already said you could do that. And it's dead. That can happen. The timing is very dependent upon real estate market conditions. If you're trying to do this at a point in time where the real estate market is dying, the builders are not interested in your property when you're done. They will not. There'll be no buyer for it because they can't build anything. They will wait till the next round and you're stuck with this land for a while. Now, if you've done it right, you just sit on that land and camp on it for as long as it takes, 5, 6, 7 years till the market comes back around again, and then you can sell it then. But that means you're in it for a lot longer than you originally planned. It can be very long term if you so-called miss the market, if you got in too late. There's typical risk of land ownership, meaning when you own land, there's risk of owning land. Somebody can go out there on their ATV and flip it over and break their neck, and they sued you even though they were trespassing. Those kind of things can happen. So there is risk of owning land. Kids can go out there and be playing with matches and start a fire, and it was on your land, and now all of a sudden you're liable. AHJs are agencies having jurisdiction. An agency having jurisdiction is the government authority that is providing the approvals that you need. Typically it's a city, and if you're not in a city, it's going to be the county. That's typically your agencies having jurisdiction. They can be unpredictable. They've got what they call a zoning plan and a general plan, and the general plan is supposed to be telling you this is what we'd like to see on this land. Some cities really go by those, and some cities not so much. And it can be surprising what you run into. They can be unpredictable, and you find out that what you thought you were going to be able to do is not what you can do. So there's a lot of due diligence and research you have to do ahead of time. So that's the risk of getting into these. It may or may not work out the way you want, just like anything else in life that you plan. So what's the upside? Where's the reward on this? Well, this is where real money is made in my experience. I have built high-rises, and I have built educational institutions, and I have built religious institutions. I have built tracts of homes. I have built apartment complexes. I've built a lot of different things. I have also done the land. I've done the design, managed the design process, land planning, those type of things. This is where the real money is made in my experience. Okay. You can build a very sustainable portfolio of these kind of projects. The real money in the business enterprise can easily pass to legacy. So again, these are business enterprises that we set up to do these projects. And if you set up a parent company where all these little baby companies are individual projects that come and go, that can pass on to your legacy without probate or wills or those type of things, because they are shareholders in that parent company. You can structure to pool resources and have experts manage it. So again, we had that issue where it takes a lot of capital and takes a lot of expertise. Well, you don't need the expertise and not a lot of capital if you pool your money with other people who are also investing in a project that is managed by people that know what they're doing and have a very strong track record of success. And there's no risk from building or developing, because in these projects we sell them before any construction happens. So there is no risk for the development or the construction of it. Development meaning the build out of the infrastructure, curbs, gutters, utilities, all those kind of things, storm drains, water systems. The building itself is going to be the homes or the commercial buildings that go on these once it's done, once it's all developed. So you can avoid that risk by just not building, and we just deal with the land the way it is. So now there's ways to mitigate some of these downsides of these projects, and that is by very carefully selecting which agencies having jurisdiction that you will work within, their boundaries. We pick entities, agencies, public agencies that are very pro-growth. They want the rooftops. They want to see growth in their city because that means they can build more commercial, which gives them more tax revenue. And they will also, we only work with cities that are predictable and reliable. What they say is what they mean. We don't ask for variances or anything special. We don't want any special treatment. Tell us what your rules are. And as long as you play by the rules, we'll play by those rules and we'll all get what we want in the end. So last thing I want to compare. People are familiar with house flips. I want to compare them to land flips and see what they look like. So we have a graphic coming up on your screen. And in the house flip, we'll start on that side of the screen. A house flip, you have to qualify to purchase a loan to buy the house. Purchase loan. You have to gather a large down payment to do that. You need to buy the house with loans or a huge amount of cash. You need to purchase your building supplies. You need to pull your permits, work with designers and engineers for any work you're going to be doing. You need to work at hard labor yourself, or you need to contract with a contractor to do this. You need to pass your inspections, get your certificate of occupancy, list, and then work to sell this piece of property that you fixed up. You need to pay on your loan until the project is sold, even if that takes longer than you thought, and then you hope you make some money at the end. That's a typical land flip. A little more complicated than what they show you on TV. In a land flip, you, as the investor, you invest funds with a pool of investors. Then the entity managers, they will purchase the land with cash. They will manage the project and do the acquisition, the reports, the planning, the entitlement. They'll go to planning commission meetings, negotiate the sale to the builder. They'll wind down the entity, and then you will get a check. So in the land flip, you do two things. You write a check to invest, you receive a check when you're done. That is the essence of what a land flip is. So with that, I just want to leave you with, always do your homework, always do your research, and know what you're getting into, fully vet whoever you put your money with. We've been talking about creative real estate investing known by the pros, and the way you as a regular person get in to do what the moguls do. This is Building Solid Foundations. I'm hoping that this information has helped you to get some information to build a solid foundation of your own personal wealth in the future. We'll see you next week, and don't forget, if you missed the first part, check out part 1. It goes with this part 2. I'm Steve Matley. We'll see you next time on Building Solid Foundations.